Okay, let me introduce myself. First of all, my name is Michalis Florentiades. I am the Chief Economist, Head of the Investment Research Department here at xm.com. And we are going to go through basically an overview of what happened during the third quarter, what are going to be the key themes in the final quarter of the year, which we have entered a few days ago, October, November, December, and what will be important, what has already taken place, and I think it's a very good idea to have this kind of perspective, what is going on in the markets, not just to get lost in the day-to-day news, but step back and see the big picture from time to time. This is what we are going to talk about today. First of all, we're going to look at the performance of both foreign exchange and some major asset classes or investment classes, if you prefer, what have bonds, stocks, and some commodities done, as well as foreign exchange. And then we'll talk about the big currencies, those that are more interesting to everybody, most interesting to everybody. We will talk about the US dollar. So have the bulls made the easy money already there, being long the US dollar? About the euro, we will ask, are we going to get extra stimulus, Japan-style extra stimulus? For the Japanese yen, again, we are having the question of whether we are going to have extra stimulus because of the drop in inflation. And for the pound, the British pound, is it a case of rates lower for longer? Is the Bank of England going to delay hiking interest rates? Is the second half or the fourth quarter of 2016, well over a year from now? Then finally, we're going to look at the Australian dollar and, of course, a few pointers on what is happening in China and how that affected the markets. Then we will talk about the medium-term technical picture among those among you that are doing technical analysis. I hope you'll find this interesting, these studies. And then we will round up with a few interesting trades, more how we construct the trade and what the thinking is behind it rather than a sure and easy way to make money. So let's begin. Now, as you can see from this, we look at the extremes first of all. We look at the worst performers against the US dollar have been the Canadian dollar, the Australian dollar, and the New Zealand dollar. So all three have a relationship with commodities. That's important to note. Also, we see that since the beginning of the year, euro dollar has come down despite the euro's resurgence. Lately, we are seeing that the euro dollar has quite significant losses. They happened mostly during the first quarter, by the way, the losses in euro dollar, the world's most traded exchange rate. Whereas the pound with some small losses, and actually the one currency that is rather flat, that managed to hold its own more or less against the US dollar, has been the Japanese yen. So more or less flat Japanese yen for the first 9 months and something. So this is since the beginning of the year, this chart. But then we are going to look at what happened during the third quarter, so July to September. What some interesting things to look at from here is that the euro actually didn't have such a bad third quarter. It gained against the pound, it gained against the dollar, whereas You see the commodity currencies that have been the big losers, the loonie, the Kiwi, and the Aussie. The loonie is the Canadian dollar, the Aussie, the Australian dollar, and the Kiwi, the New Zealand dollar, were all big losers during the third quarter as well. So this is something to watch. And also that the yen was stronger than the dollar during the third quarter. Now, some of you may ask, should we care about what happened during the past 9 months? We want to know the future, obviously, not what happened during the first, not what happened in the past, and we don't want to know history. But I think for foreign exchange traders, it is very important to know who are the big movers and where are the big trends right now in foreign exchange. And looking back helps us to determine where these big trends are and why are they important to know. I think a golden rule in trading is to don't get in front of a steaming train. What does that mean? If we know that there has been a major trend in the market and certain currency has been moving up or down very strongly, it's not exactly wise to go against that trend and to bet against that trend. So this is one thing that is definitely, we can save a lot of money from not betting against a big trend in the market. Now, the emerging market currencies, some of you are from emerging countries, were the worst performers actually of the year. They are not in the chart. I just put up some major currencies in the chart, people that more or less everyone will be familiar and will be trading. But the worst performers were the Brazilian real. It lost nearly half of its value versus the US dollar. Some big knocks were dealt to the South African rand, the Russian ruble, and the Norwegian krona. And again, you see the connection here. The common theme between these big losers have been their dependence on commodities. So emerging markets that were dependent on commodities, partly such as Brazil, such as South Africa, such as Russia also with some geopolitical element as well, of course, but these currencies were the worst performers, the ones that are dependent on commodities. So maybe now is a good time to ask oneself, should we be or not be a contrarian? Who is a contrarian? Contrarian is the trader that goes against the predominant trend or the predominant sentiment. So now let's say the predominant sentiment is to be short emerging markets and to be short emerging market currencies. So isn't there a good value? Isn't it a good idea to do something that something different from everyone else? Maybe it's a good idea in the long run, but in the short run, I have to point out that what is cheap can also become much, much cheaper. And if you are trading, you are very interested in the short run and you don't want to have trading losses by betting against the mood and being proven wrong and doing it again and again. This is something that many beginner traders do, unfortunately. Now, back to our developed markets, countries, or developed or the major currencies. As we said already, the commodity currencies of New Zealand, Australia, and Canada were the worst performers. So the dollar complex. So the dollar is the US dollar. When we are talking about dollar, of course there are many dollars, but when we talk about the dollar, mainly we talk about the US dollar, was overall strong. It is having a good year, the US dollar, but it did not manage to make any gains against the yen. So that is interesting. The euro fought back from a weak position in the third quarter as doubts arose on Fed hikes and as it gained because of its safe haven role. So the euro, we discovered, is some sort of safe haven currency. Lately, what does safe haven mean? When things go bad, the euro tends to appreciate. So the pound was also hurt after a strong first half. It was one of the market darlings, the pounds. I liked it quite a lot myself, but seeing that things were that the Bank of England is maybe not so much in a hurry to raise rates, people were expecting maybe interest rates to rise by the end of the year. If that is not happening for another year, well, you can understand that it can take a toll on the currency. Now this is where we look back and see what has done well. So where would we have made money if we were the most money? Which investment was the best investment for the first 9 months of the year? Now, it appears overall that 2015 has been a difficult year for investors. The only things with a positive performance were Japanese stocks and US treasuries. Those were the only two positive asset classes from the ones that we looked at. But they were only positive by 2 to 3%. Don't imagine anything anything super large or outsized gains. Developed equities, so the big stock markets of the world, these are the developed equities, were flat on the year, so zero change, whereas emerging and Asian equities did much worse. They had substantial losses. Now you should keep in mind that for US-based investors investing abroad, when the dollar is going up, it means that the investment they made outside the US must be going up faster than the dollar because it's denominated in a foreign currency. So for US-based investors who are investing money outside the US, we had the negative dollar effect, and we actually saw quite a few people trying to hedge the currency exposure when they were invested in Eurozone stocks, for example, or in Japanese stocks. Now, commodities were the big loser of this year, not precious metals, but general commodities, and especially copper. Now, copper is said it has a PhD in economics. Why is that? Because it knows the global economic environment much better than most economists, it says, because when the global economy is not doing well, then copper tends to fall. And we saw this, that copper is the worst performing of the commodities we look at here. It's losses of 19%. So this is also bad news for the global economy. It means it's slowing down. Of course, monetary policy has been lax. We saw rate cuts in New Zealand and Canada, 2 rate cuts in New Zealand, 1 rate cut in Canada, speculation about rate cuts in Australia, and we saw stable rates in Switzerland, Eurozone, US and UK, but in the US and UK we are waiting for a liftoff, so rates to go up at some point. But we are still waiting and we don't know how much time we are going to have to wait for that. Let's start now to look at the big economies and the major currencies one by one, starting with the largest economy in the world, the United States. What are the fundamentals in the United States? A decent second quarter. The US economy grew by 3.9%, very respectable rate of growth, quarter-on-quarter annualized growth, I should note. Overall, the projection is that in 2015, growth is going to be around 2.5% year on year on average for the year. That's respectable growth. Just as a note, you can send in questions, but I will answer them at the end of the presentation. So feel free to send any questions that you would like, but please keep in mind that I will have to answer them by the end of the presentation. I will finish first and then we'll answer. Thank you for your understanding. Now, monthly core inflation, which excludes food and energy, so to make it more stable, to get a better idea of the underlying price pressures, it was at 1.8% during August. But headline inflation, which includes all the commodities, all the goods and services, was at 0.2% year on year, very close to zero, as you can see. Now, unemployment has dropped this year from around 5.6% to 5.1%. That is a very low unemployment rate, but the wages are lagging. I mean, the US is having trouble to post wage increases well above 2%. This is a challenge. We would like to see wages going up by more than 2 to 3%, preferably. Why? This would boost the consumer, and this would boost economic growth, of course. So here in this chart, I think it's an interesting chart. The green line is unemployment. It's for the past 2 years, by the way. For the past 2 years, unemployment has dropped quite a lot, from 7.2% to 5.1%. So that's a huge success of US economy. At the same time, if you see the orange line is inflation. Inflation has dropped below zero 3 times this year. So this makes it more difficult, let's say, even though the fall in inflation had more to do with the price of oil and with the fall in the price of oil and some extraordinary factors, still it's not so easy to raise interest rates when inflation is so low. However, core inflation, which is the blue line, you can see it's relatively stable. It's not moving up or down very much. It's around 1.7, 1.8%. So this is looking like, very fast dropping headline inflation, which is for all goods and services, stable core inflation, higher core inflation, not so far from 2%, and an unemployment rate that has been dropping. Now, as I said, this is a nice picture of the Federal Reserve in Washington. The Fed is worried about low inflation, 3 months this year negative. It's again our friend low energy prices. We find them affecting US inflation, particularly fuel prices, gasoline prices, energy, heating oil. So, some of you will know better than me how many uses oil has. But also I would note that we talked about the rising dollar, and the strong dollar is dampening non-energy import prices. So everything that the US imports will get cheaper when the dollar goes up. We also had the threat of a global economic slowdown as a result of China. China is slowing down, we said. So this has caused some concerns. Some turbulence in financial markets. So all these factors, let's say, convinced the Fed to keep interest rates unchanged. Now, In 2016, we are going to get more hawkish members in the committee, hawkish meaning that they are more prone to interest rate increases, so the balance of power may shift a little, so we'll have to see. And this is the interest rate in the United States for the past 15 years. As you can see, since December of 2008, we will get zero rate policy becoming 7 years old. Right now, the market sees a less than 1 in 3 chance of higher rates by December, and because why? The same issues that kept the Fed from tightening in September will probably not go away by December. We also had a very weak employment report the other day, weak non-farm payroll figures, so this reduces the chance of the Fed making a move. It's not impossible, but the market thinks that it's less than 1 in 3. And now the markets expect a rate rise in 2016. What's the conclusion from this? If the dollar is to gain, it will do so on other currencies' weaknesses, because this divergence argument that the US is going to increase interest rates while others are doing QE, etc., well, the part that the US is raising interest rates has definitely gotten weaker. On to the Eurozone, we have good growth of 1.5%. It's good for the Eurozone. Actually, you may be laughing. I mean, it's 1.5% good growth, but it's the best growth rate since 2011. And unfortunately, inflation is also low there, and we are going to see whether we're going to get 1% plus inflation in 2016. Unemployment stands at 11% in August 2015, and it's projected to drop to 10.6% in 2016. So not much of a drop in unemployment, I'm afraid, in the Eurozone. And here the key factors for the European Central Bank are low inflation as well as the global economic risks, because the Eurozone is quite an open economy in that it trades a lot more than the United States as a percentage of GDP with the rest of the world. The Greece issue is on the back burner right now. People are not too worried about that. Political risk has also gone down. Portuguese elections went well. Spanish elections are ahead. And of course, there is optimism that the ruling right-wing party is going to win the Spanish elections. Still, there's a huge issue of how to bring down long-term unemployment and also to bridge the north-south divide. Competitiveness, unemployment, structural reforms are needed in the south, competitiveness improvement, lower unemployment, whereas the north has done more and is for the moment leading in economic performance, and the south needs to catch up. This is more or less the prevailing view. Now, Germany is doing well. It has been rather stable, but also Italy and France, which faced some serious challenges a year or year and a half ago. They didn't look like they were looking like they were going to go into recession, are also looking more positive. Spain is also the poster boy of the reformed south and will manage to grow fairly strongly, a growth rate of as high as 2.8% next year. At this point, if anybody would like the presentation to be sent to them in a PDF file, please leave your details and just indicate that you would like it, and we will make sure to send it to you. Next are the business confidence surveys. Why are we interested in these? Because they are showing the when you ask companies how they are doing and how they see things, the answers that they give tend to be a good indication of how GDP will do. So you see with France, we had this dip in 2013. This was contraction because 50 is the contraction expansion line. So it was pretty low, well below 50, but now it has gradually climbed up to around 51, 52. Same with Italy. We see at the height of the Eurozone crisis, it was very, very bad business confidence, around 44, and it climbed. Now it's above the 50 line, so Italy is growing as well. Germany was more stable during the past few years, above 50, so expanding at a steady pace. And Spain, you can definitely see a huge improvement in the PMI from well below 40, so that's deep in contraction territory. In late 2011, it has reached, now it's around 55. It was as high as 57, 58, the composite index for business confidence. So things definitely looking better for Spain. This is the picture with the blue line. It's core inflation, similar to what has been going on in the US, but with some key differences. What are the key differences? Core inflation is about 1% lower in the Eurozone. Unemployment, although the graph may make you think that it's fallen quite a lot, the drop has not been so big because it's from 11.9% to 11.1. That's not a very big move. So, and also we see that the inflation has dipped to, there was quite serious negative inflation at certain points for the Eurozone. Now the ECB's QE program, it was started this year in late January, if I'm correct, if I remember right. It has helped the Eurozone to recover economically. Now, there are still some problems with low inflation. These were caused by the low energy prices. So when oil fell to around $40 a barrel and below 40, also at the same time the euro rebounded. It was a time that the euro rebounded from around 105. It went up to as high in August of 117. So this brought a little nervousness to the ECB that their inflation target would not be successful. So now the speculation is that the ECB is going to do more QE. Remember that September in 2016 is supposed to be the end date for its present QE program. So some sort of expansion is looking likely, and we'll see whether we get extra QE, additional QE as a larger program. On to Japan. Japanese economy not doing so well. Okay, it's not in recession. It's around 0.6% according to the IMF, these projections. 0.6% in 2015 and 1% next year. That's relatively low GDP growth. Inflation is going to hit 2% by September 2016, according to the Bank of Japan. This is looking optimistic because the IMF is predicting slow inflation this year and next year. So we'll have to see what happens in Japan and with inflation. Unemployment rate in Japan is low, 3.4% in August 2015. Most countries would be very jealous of such a low unemployment rate. And now we are seeing some issues. Japan is also plagued by issues such as deteriorating demographics. So more and more people getting old, fewer people are working. Also low inflation, like deflation kind of scenarios, and now of course the slowdown in China, its major trading partners. This is just to show you what inflation has done with the orange line. So maybe you say, wow, inflation was doing really well. In 2014, what happened? I mean, was it just the oil price? Well, no, actually it was the sales tax increase that accounted for most of the inflation that you see in the chart, and that underlying inflation is pretty benign. Unemployment rate, as we said, very stable, even falling to around 3.3, 3.4%. Now the speculation right now in the market is because inflation is not doing, maybe if the Bank of Japan sees that it's not going to achieve its inflation target, it could expand its already massive 80 trillion yen, which comes around to $666 billion annual QE pace. And by the end of October, we're going to have the anniversary of last year's shock announcement, when they also increased QE and they caused a rapid drop in the yen. So maybe some traders are afraid of something similar happening this year. The government could also go for additional stimulus, fiscal stimulus, and we also had a growth hiccup in second quarter, minus 0.3%. This was some special extraordinary factors, but if we get another bad quarter in the third quarter, we could have a technical recession. It could push the Bank of Japan to move earlier. The other day we had a decent Tankan survey. This is a quarterly business confidence survey taken by the Bank of Japan. And remember that the yen is playing a safe haven role. Now, on to the UK. Relatively strong growth of 2.5% this year, similar to the United States, if you remember. We are also predicting 2.5% growth in the United States, but inflation is only going to be around 0.1%, very low inflation. Inflation should pick up to 1.5% next year, but growth is going to slow to 2.2%. So the UK does not have accelerating growth. Unemployment has dropped to 5.5% from a peak of around 8.5%, but inflation is also lower. So yes, dropping of unemployment, but inflation drops as well. So this is a little confusing to central bankers because they're used to lower unemployment bringing higher inflation. And there are some worries that global slowdown and the turbulence in financial markets could heavily weigh on the open UK economy. This is a similar picture. Headline inflation around zero, the blue line. Core inflation is higher, a bit above 1%, and dropping unemployment. Now, as you remember, the May elections, when the Conservatives won, was positive for sterling, but we have other political worries right now. We have Brexit, which is Britain's possible exit from the EU. The Bank of England is being priced as very dovish. There are some in the markets that are predicting that it will not move until the first quarter of 2017. So that's almost 1.5 years from now. That's a very dovish projection. So the catchphrase is lower for longer. Interest rates to be lower for longer. Brexit has become a more likely scenario. It was more of an outside chance. Now the polls are showing the people in favor of UK exiting the EU to be more. Of course, some are saying that this is it's natural for the polls to go between yes and no, and that we still have a long way to go. Now, there is zero inflation because of lower energy and food and other imported prices and the strength of sterling, but there is also some slack in the economy. So there is the economy could expand by more. There are some unutilized resources, if you like. The wage growth has been improving. It's up since March to over 2%. It has climbed above 2%. That's a positive development. And one important detail is that most market participants expect the Bank of England to hike after the Fed. So the more the Fed delays, the more the Bank of England will also delay. On to Australia. Decent growth, 2.4%, so very close as the UK and the US, but it's actually forecast to accelerate to 2.9% in 2016. And I think this is the only one of the countries with a decent headline inflation rate from the ones that we are watching. So headline inflation is forecast to be around 1.8% in 2015 and 2.6% in 2016. Unemployment has made multi-year highs though, over 6% recently. I think it's 12 or 13-year highs. So that's very strange because a lot of European countries associate unemployment of 6% as being very low. In Australia, it's actually a very high rate. They haven't had this unemployment since 2002, 2003. Now, the key challenge that the economy is facing is to shift the growth away from mining and mining investment and towards domestic demand. Now, China is, of course, the country's top export destination, particularly for commodities, and this is hurting the Australian dollar and the economy because the price of exports, very important for the Australian economy, is falling. So the value of exports are also falling. Here I showed you that I show you how unemployment has climbed in Australia from around 4.9% to 6.3%, 6.2% lately. And you can see with the GDP, this is a quarterly GDP. I mean, these GDP changes are lower than this. So you see from after 2013, we see the lower commodity prices hurting the Australian economy. Why is this happening? Oh, maybe this chart is going to help us. So we are seeing the Chinese growth rate for the past 10 years. So as you can see, right before the financial crisis, the outbreak of the financial crisis in late 2007, China's economy was growing by more than 14%. That's a breakneck pace, and that's a really amazing growth. But since then, we are seeing steady deceleration in growth. And now we are seeing around 7% growth in China. Still good, still high by most world standards, but it is a slowdown, slower growth. Now, the Chinese economy has been slowing down for a while, as we see from this graph, but recently it has been in the headlines a lot because we had firstly a couple of rounds of yuan devaluation. The Chinese yuan value fell by around 4%, not by much, 4% did not move, but people were afraid that this may lead to more devaluation. And the second destabilizing factor out of China was a continued drop of Chinese stocks. So the Chinese stocks, they fell from around 5,000, which was the peak of the index, to around 3,000. That's quite a substantial drop. Of course, they were 2,000 1 year ago, so we have to keep things into perspective. So there is a slowdown in China and the and other emerging markets, and this is assessed for the impact on the global economy. And we have 7% growth. It probably will not hit 7% growth. China won't hit 7% growth, but people are a little worried about the statistics as well. They are not sure if the official statistics are telling the entire story, or if things are better, if they are worse, etc. Now we are going to look at the Big Mac index. This is just an indication of fundamentals for exchange rates. The theory, economics, tells us that, when you exchange a dollar into pounds, okay, you ought to buy the same things that you can buy in New York, you should be able to buy in London. So this is the idea behind this purchasing power parity. And the Economist magazine has a Big Mac index where it compares all the different prices of Big Macs around the world. This is something very easy to get. So they compare the prices of the Big Macs and they adjust them for the local currency, and they find where are the cheapest Big Macs, so those currencies are likely to be undervalued, and where they are the most expensive Big Macs, and those currencies are likely to be overvalued. And I think their results, by the way, generally agree with purchasing power parity, like more complicated methods to reach the same conclusion. Now here we see some very interesting conclusions. First of all, the Swiss franc is way overvalued. Way overvalued by more than 40%. This agrees with other studies as well. So this is just fundamental. Doesn't mean that because it's overvalued, it cannot get even more overvalued. So this does not say go short the Swiss franc now. It just says that in the long run, it's possible or probable that the Swiss franc might lose value. Now, for these currencies like the euro, the Canadian dollar, British pound, it's not so. I mean, the euro, yes, it is slightly undervalued in purchasing power. But if we look at the currencies that have been sold very heavily against the dollar in not only 2015, but in recent years, I would say, for example, the Japanese yen or the commodity currencies, Australian dollar, New Zealand dollar, and also the emerging market currencies, they are looking very undervalued versus the US dollar. So that's something interesting. The most undervalued, of course, looks to be the Russian ruble. So that's where the cheapest Big Mac is right now, is in Russia. So, over the long term, we should expect the ruble to appreciate. Summary, before we go on to some technical studies. The US dollar has stalled after the Fed's inaction. Yes, the US economy is growing, maybe the Fed will raise soon, so this is supportive. The pound, the UK economy has a lot of exposure to the global economy. The Fed's delay and lower inflation have reduced hopes of sterling bulls to see a rate hike soon. It has potential still though. And why we said the Fed delay, that generally we expect the Bank of England to come out after the Fed. The euro, we had the threat of extra QE, so this is against it, but it's also looking that euro economies are doing better, they are posting growth, and the currency can benefit from safe haven flows. So a lot of people shorted the euro before, now they have to buy it back, and this is something that they borrowed euros rather, and when things are not going well with the investments they made, they sell those investments and they repay the euros that they borrowed. This is a way to see how the euro is a safe haven. Now in Japan, similar argument maybe with the euro, but even more because we have threat of extra monetary stimulus, which is a negative, but we have the safe haven allure of the yen. The yen is also cheap on purchasing power parity. We said that from the Big Macs, one of the cheapest Big Macs you can get is in Tokyo right now. So we'll keep that in mind for the yen. The Aussie is getting hurt by the Chinese slowdown and the commodity rout, so the drop in commodity prices. But the RBA, the Reserve Bank of Australia, no longer says it's expensive. This used to be a staple of the RBA statements when the Aussie was at 80, 85, 90, above 1 against the US dollar. Now at around 70, 72, they dropped that line. They think that it's not, they can't say that the Aussie is expensive anymore. Some technical analysis now. Euro USD with the dollar is looking rather bearish, but we have seen some more positive developments lately. It's trying to get into the cloud. The cloud is very thick though at this point, so maybe there will be some challenges for the to manage to break through the other side of the cloud. So a generally bearish market. The weekly chart is showing some bearish market, but which is retracing some of its losses, some of its recent losses. So some shorter term indicators are more positive from here. But recently it has been more or less a range for the Euro USD, and many analysts are expecting the Euro USD to stay in that range for the remainder of the year. The Japan dollar yen is looking bullish, so this is the long-term chart in favor of the US dollar. We have the cloud is moving sideways, so it may be showing some consolidation before it moves higher. And we are going to see whether we need to see whether it can take out the 125.84 high. And we see the 120 level, how much trading there has been around this level. It's an important psychological level, and sometimes these levels act like a magnet, and it's very difficult for the market to get away from them unless something big happens. Now, the pound dollar, we are seeing also a negative trend, but some retracement. More recently, the picture has become more mixed. We have had some positive crossovers with the Kijun-sen and Tenkan-sen lines, and the prices are piercing the cloud right now, so it's not so clear that it's still in this, it is in the downtrend, but it is trying to, I think the picture is more rather mixed. RSI is bearish below 50, but close to 50. So I would also say about this pair that it's mostly range trading for now. I think especially 150 to 159.30 is the broad range in which it trades. It has traded lately. The euro pound, the pound had been strong against the euro, but it didn't manage to keep the euro below 70 pence, and now we had some positive price movement towards the cloud. So again, the picture is becoming more is becoming less clear because we have this reaction. Overall, I would be a little bearish the euro and favor the UK pound. I think that the long-term trend is going to re-establish itself, but it's an interesting reaction that we are seeing right now. the RSI has also crossed above 50, which is rather bullish. Now the Aussie, I think the Aussie has a somewhat clearer negative picture on the weekly chart. So these are long-term charts. Keep in mind, yes, we have had an attempt to break out of a descending channel, but this has been a very steep descending channel, so some reaction is expected. Overall, I would also expect the dominant negative trend to reestablish itself soon. And just some favorite trades for until the end of the year, since you know, we have a lot of range trading as well. If the commodity route continues, so if commodity prices keep dropping, the Australian dollar will probably get hit more. So right now we have had a fairly nice retracement of the Aussie. So if it is sold short around 72 cents, then maybe to place a stop around 74.40 and target a retest and a takeout of the August lows of 69 cents. And also somewhat contrarian play is a short dollar yen. Dollar yen from the weekly chart was not so looked positive. On the weekly chart. On the daily chart, it is less clear. There are things happening that are a little more yen friendly. And I'm a little impressed by the yen's resilience, that despite huge bearishness on the yen, and we are seeing, you know, the Bank of Japan printing so much yen, the dollar has not managed to make any substantial headway this year. So this for me is making me look at the yen a bit closer. Now the high for the year was around 125.80. So if we place a stop around 120 and then target the low of 116, so it's and try to see, this will also benefit from any further volatility or turbulence. So these are just some thoughts on trades we could try out. That's all from me, the presentation. If you have any questions, I will try to answer them. Just send me your questions and now I have a question about whether the euro and the Swiss franc will be strong in the future, given this stability. There is a lot of intervention in euro Swiss franc from what I'm seeing, that I think the Swiss National Bank is also intervening in favor of the Swiss franc right now, and is trying to drive it lower and buying euros. So this is according to, yes, the Swiss franc should lose ground, especially since we saw from purchasing power parity it is very overvalued. So in the long run, it should move in that general direction. But you know, if we get, and it's strange because both the euro and the Swiss franc are safe havens. So we'll have to see if the ECB does more QE, then that will hurt the euro. But other things being equal, I think that the Swiss franc should weaken. Now, is inflation better to be negative or positive is another question that I have. Generally, central bankers are afraid of negative inflation, because if you have a negative inflation, they are afraid that consumers are going to delay their purchases. So they are not going to buy things. and wait for them to get cheaper, and this is going to lead to a deterioration in economic activities. I don't think that negative inflation, small negative inflation, is such a negative thing myself, because it makes consumers feel better because the money that they have in their pocket is worth more. But central bankers try to avoid deflation, and they try to go for positive deflation around 2%. And this is one reason that we see this delay in interest rate hikes, because both in the US and maybe the UK, because they want to make sure that inflation is going to head towards 2%. The same thing is happening in Japan. They want the inflation close to 2%, otherwise they're going to print more money. Same in the Eurozone. Now we haven't looked at that crude oil. There has been a sharp snapback for crude oil in the latest trading. Overall, though, I would say that the trend in crude oil is probably negative. We have a slowdown. So I hear a lot of fundamental analysts saying that crude oil will stabilize at a higher price from here, but we need to see more production cuts, and I need to see some reports that say that some of the producers have actually stopped producing and there's not a daily surplus in the market before I make that call. So for the moment, I'm a bit negative on crude oil. Now, on gold and silver, the two precious metals, overall gold and silver are benefiting from the fact that the Fed has not raised interest rates, and maybe they will not raise interest rates until early 2016. This has boosted gold. It helped it a lot, but not too much from what I see. Overall, I think they are both fundamentally, they are attractively priced. The price is not bad, but we should keep in mind that the dominant trend for gold and silver is down, and we haven't seen any real signs of bottoming. Maybe for gold, if we take out the 1200 level, it becomes more positive. But I mean, yes, there are some positive fundamental developments. Gold is also close to its production cost, around $1,000, a lot of people say. But if we have if there is a negative primary trend, we should be alert and try to invest in gold when also the fundamentals become more positive. So for dollar yen, the trades that we said, this is just an idea. Of shorting dollar yen is just something to think about. I'm not saying that it's a possible trade. Just to think about it, to analyze yourselves. I tried to give you some positives and some negatives, and I also told you that it is risky from the fact that we saw that the dominant trend in dollar yen has been an uptrend in the weekly. So shorting it goes against the dominant long-term trend, something we shouldn't do. But we said there are these characteristics which are in favor of the yen, can make it interesting, and it's maybe a bet on turbulence, more or less. For stops and targets, I thought that we mentioned a few. Here also you can use, I think you should use the charts for stops and so for example, for the Australian dollar, 69 cents is an important level. If we look at the recent high, 74 cents here is also important level for. So please use the charts to help you to determine some levels, keeping in mind, of course, always that if you use the charts, there is also, you're not the only one out there who is using the charts. Many will try to take advantage, and they know that maybe there are a lot of stops around that level, and you are going to get taken out. Now for buying Euro USD, we said that Euro USD is probably around a range. It's trading in a range. So, I mean, if you find Euro USD around 111, 110, 111, maybe it's a good idea to buy it. If you find it around 114, 115, maybe it's a good idea to sell it. But these are not trades with a lot of potential to make money, because uh, many analysts, including myself, don't see a major trend developing for euro dollar until the end of the year. So when you are trading in the ranges, you have to keep also tight stops because you are not aiming to make a lot of money. You have to be content with small moves, and it's something that not so easy for people to do. Okay, well, it's about an hour since we started, so I don't want to tire you too much. Unless you have any other important questions, I will bid you goodbye. Thank you very much for attending the webinar today, and I will try every quarter to give you an update of what is happening. It's also very good exercise for me to try to get together you to see what your questions are and what were the important things. Till then, bye bye.